There's a moment in markets when nothing looks urgent, but everything underneath is starting to break. Right now, that moment may already be here. Not on the charts, not in the headlines, but deep inside the system. Because while everyone is watching interest rates, oil prices, and geopolitical headlines, a quiet supply shock is forming. And it's not coming from demand, it's coming from the foundation of production itself. This isn't speculation, this is already happening. If you want real signals, not noise, stay with me till the end. And if this kind of deep analysis matters to you, hit like, subscribe, and drop your view below, because this conversation is just getting started. Now step back for a second. The global economy is already under pressure. The International Monetary Fund has been warning about slowing growth combined with persistent inflation, a condition markets historically associate with high volatility and uncertain asset pricing. Central banks, especially the Federal Reserve, are stuck in a difficult position. Tight liquidity to control inflation, but weakening growth signals. This matters because in this kind of environment, commodities don't move randomly. They respond to structural stress. And right now, a structural stress point has just been triggered. China, the world's largest producer of sulfuric acid, is moving toward halting exports starting May 2026. This is not a rumor. This is already being discussed by analysts and industry sources. At first glance, this sounds like a chemical story, but it's not. Sulfuric acid is not optional. It is essential for copper extraction. And here's the part most people still don't understand. Silver doesn't come mainly from silver mines. It comes from copper. Around 70% plus of global silver supply is a byproduct of base metal mining, which means if copper slows, silver supply tightens automatically. No debate, no delay. At the same time, the Iran conflict has already disrupted global sulfur supply chains. The Strait of Hormuz, a critical route, has limited shipments of sulfur, which is the raw material used to produce sulfuric acid. Now connect the dots. War restricts sulfur. China restricts acid exports. Mining operations lose key inputs. This is not a single event. This is a multi-layer supply squeeze. And here's the important part. Supply squeezes don't show up instantly. They build pressure first. Then they release suddenly. Pattern interrupt. Stop thinking about silver like a simple commodity. Start thinking about it like a chain reaction asset. Because right now, multiple chains are tightening at once. Even before this disruption, the silver market was already under stress. The market has been in a multi-year supply deficit. Inventories have been declining. Demand has been exceeding supply. Now layer this with something even more important. There's no quick replacement for sulfuric acid supply. Building new capacity takes 18 to 24 months. So this is not a temporary issue. It's a time-delayed constraint. And time-delayed constraints are the most dangerous type because markets tend to react late. Institutional players don't react to headlines. They react to supply dynamics, liquidity, and cost curves. Right now, input costs are rising. Supply chains are tightening. Production margins are under pressure. Copper smelters are already considering output cuts and maintenance delays, which means this is not theoretical anymore. It's operational. If copper production slows over the next few months, how much silver supply disappears with it? And why are markets still pricing silver as if nothing has changed when the inputs are already tightening? That's where things start to get uncomfortable. Because historically, commodity markets don't move based on what is happening now. They move based on what is about to happen next. Now, let's be clear. This does not guarantee a price surge. Markets are complex. Demand could slow in a weak economy. Central banks could tighten liquidity further. Volatility could increase in both directions. But historically, when supply constraints meet already tight inventories, markets tend to reprice over time. Not instantly, but eventually. Right now, you are seeing the early signals, not the full move. And in the next part, we're going deeper into, institutional positioning market liquidity behavior, and why volatility may increase from here. Because if this pressure continues, the current price may not reflect the full picture. If you've made it this far, you're already ahead of most people. Comment below, do you think silver is underpriced right now, or is the market already ahead of this story? Because the next part is where everything starts connecting. What you're seeing right now is not just a supply issue, it's a system-level shift. Because when supply chains tighten, markets don't react immediately. They adjust through liquidity, positioning, and volatility. And that's exactly where we are right now. Institutional investors don't react to headlines. They track input costs, supply disruptions, forward pricing expectations. And right now, those signals are starting to align. Look at what's happening inside the copper market. China, the world's largest copper producer, is already seeing pressure on smelters. Some are considering output cuts, maintenance shutdowns, reduced processing activity, because the economics are shifting. Why? Because sulfuric acid, a key byproduct revenue stream, is no longer behaving normally. This matters, because when smelters reduce output, it doesn't just affect copper, it affects everything tied to copper, including silver. Now step into the macro picture. The Federal Reserve is currently balancing two forces: inflation pressure, slowing economic growth. This creates tight financial conditions, which means less liquidity in markets, higher borrowing costs, more sensitivity to supply shocks. And historically, when liquidity tightens, commodity markets become more volatile, not necessarily directional, but unstable. This is critical, because supply disruptions in low liquidity environments tend to amplify price reactions later, not immediately. But when they hit harder. This is not about silver going up tomorrow. This is about pressure building today. Now zoom out. This is no longer just China. Other countries are starting to react. India is already considering restricting sulfur exports to protect domestic supply. Turkey has already moved in a similar direction, and the Middle East, which accounts for a major share of global sulfur supply, is facing disruptions due to ongoing conflict. So now think about this globally. China restricts acid. Middle East disrupts sulfur. India considers export limits. This is not a local issue anymore. This is a global tightening cycle. And global tightening cycles historically lead to supply shocks across commodities. This is where things get real. Production costs are already increasing. For example, rising sulfur prices are increasing mining costs. Nickel and copper producers are seeing cost spikes. Some operations are already cutting output. In fact, the Iran-related disruption has already pushed up costs significantly for producers relying on sulfur-based processes. This is important, because rising costs eventually feed into price discovery. But there's lag. Markets don't react instantly. They wait, they absorb, then they adjust. Curiosity. What happens when production costs rise, but prices haven't adjusted yet? And what happens when multiple countries start restricting supply at the same time? That's when things accelerate. Now let's be clear. This does not guarantee a straight upward move, because there are real counterforces. Global growth could slow further. Industrial demand could weaken central banks, could tighten more aggressively. But historically, when supply constraints combine with tightening inventories, markets tend to reprice gradually. Then suddenly, not in a straight line, but in phases, silver sits at a unique intersection: industrial metal monetary hedge. Supply constrained byproduct, which means it reacts to economic growth, inflation expectations, supply chain disruptions. And right now, all three are shifting. That doesn't mean immediate breakout, but it does mean the structure underneath the market is changing. Live visual moment. Imagine this happening in real time. Factories running, but inputs getting tighter. Smelters operating, but margins getting squeezed. Supply chains moving, but with increasing friction. At first, nothing looks broken. Then suddenly, everything starts adjusting. Transition. Right now. We're still in the early phase. The signals are there, but the full impact has not been priced in yet. And in the next part, we're going deeper into market positioning, inventory pressure, and why timing matters more than direction. Because this is where the story shifts from what is happening to what could happen next. If you're still watching, you're already ahead of most traders. Drop a comment. Do you think this is a real supply shock or just temporary noise? And don't forget to like and subscribe. Because part 3 is where we connect this to price behavior and market timing. At this stage, you've seen the supply story, you've seen the macro pressure, but now we move into something more important, market structure. Because markets don't move on headlines, they move when structure starts to break. Right now, the silver market is not operating with excess supply, it's operating with declining buffers. According to industry data backed by the Silver Institute and Metals Focus, the global silver market is entering its 6th consecutive year of supply deficit in 2026, and more importantly, over 762 million ounces have already been drained from inventories since 2021 pause. There. That's not small. That's almost an entire year of global production, already gone from above ground stock. Now think about what that means. Markets don't run out of supply overnight. They run out of flexibility first. And that's what we're seeing right now. Here's where most people get it wrong. They look at exchange inventories, visible stock levels, reported supply numbers, and they assume everything is stable. But here's the reality. Not all inventory is available. Inventory, a large portion is locked-in ETFs held by institutions or strategically stored, which means when demand rises or supply tightens, the market has less usable liquidity than it appears, and historically, that's when volatility begins. This is not a shortage story. This is a liquidity story disguised as a supply issue. Right now, silver prices are still reacting to macro conditions. Interest rates, dollar strength, risk sentiment. But underneath that, a different force is building. Because when inventories decline over multiple years and supply disruptions start layering on top, the system begins to tighten, not visibly at first, but structurally. And historically, when that happens, price doesn't move slowly, it moves in repricing phases. What happens when inventories fall, but demand suddenly increases again? And what happens if supply disruption hits? Exactly when liquidity is already tight, that's when markets shift. Now look at the broader system. Across major hubs, London vaults, COMEX warehouses, Shanghai inventories, stock levels have been trending down over time, not collapsing, but slowly declining. And this matters because slow declines are often ignored until they reach a tipping point. At the same time, production is becoming more expensive. From earlier reports, sulfur prices have surged due to supply disruptions. Acid prices have increased sharply in key regions. Mining costs are rising across copper operations. For example, sulfuric acid prices in some regions have already surged significantly due to supply shortages and war disruptions. And here's the key point. When production costs rise, it changes the minimum viable price. Not instantly, but structurally. Markets don't react to cost increases immediately. They absorb them. But eventually, producers adjust. Supply tightens further, and prices begin to reflect new realities. This is how commodity cycles historically behave. Picture this. Warehouses still showing inventory, but less available than before. Mines still operating, but with tighter margins. Supply chains still moving, but with increasing delays. Everything looks normal, until suddenly, it doesn't. Now let's be clear. This is not a guaranteed outcome. There are real risks. Industrial demand could weaken further. Global growth could slow. Central banks could keep tightening. In fact, recent data suggests industrial demand may soften due to economic slowdown linked to geopolitical tensions. So this is not a one-direction story. It's a pressures-demand balance. But here's the key takeaway. Supply constraints, combined with declining inventories, create conditions where price volatility increases. Not certainty, but probability. Markets are not about direction. They are about timing. Right now, we're not at the end of this story. We are somewhere in the middle. The supply shock is forming. The inventory buffer is shrinking. The cost pressure is rising, but the full repricing has not happened yet. And in the final part, we're going to connect everything. Supply disruption, institutional behavior, macro environment, and potential price scenarios. Because this is where the question changes from what is happening to what happens next. If you're still watching, you're thinking ahead of the market. Comment below. Do you think this turns into a real squeeze or just another temporary cycle? And make sure you like and subscribe, because part 4 is where we break down possible outcomes and scenarios. Now everything comes together. What started as a chemical export decision is now connected to global supply chains, mining production, monetary conditions, and market liquidity. This is not one story. This is a convergence. And when multiple forces converge in commodities, markets don't react slowly. They adjust in phases. As of today, the silver market is already operating under pressure. At the same time, supply is now facing additional disruption. China restricting sulfuric acid exports. War disrupting sulfur shipments. Mining costs increasing globally. And importantly, there is no quick fix. New supply chains, new chemical production, new infrastructure. All of that takes years, not weeks. Now let's break this down clearly. No hype, no guarantees. Just real possibilities. Scenario 1. Controlled adjustment. In this case, supply disruption is absorbed slowly. Industrial demand remains stable or slightly weak. Central banks maintain tight monetary policy. What happens? Silver moves, but gradually. Prices may rise over time, but volatility stays contained. This is the most stable outcome. And historically, this happens when markets have time to adjust. Scenario 2. Supply shock plus liquidity. Stress. Now consider this. If copper production slows faster than expected, acid shortages worsen, inventories continue declining, and liquidity remains tight, then pressure builds quickly because the system is already fragile. We've already seen rising sulfur costs impacting producers. Potential output cuts from Chinese smelters. If this accelerates, markets may reprice faster, not in a straight line, but in sharp, volatile moves. Historically, this is when commodities surprise investors. Scenario 3. Demand weakness offset. Now the opposite risk. If global growth slows significantly, as the IMF has warned about weakening economic momentum, then industrial demand may decline. Manufacturing slows, commodity consumption reduces. In this case, supply pressure is partially offset, and price movement becomes less aggressive. This is why there's no guaranteed direction, only probabilities shifting over time. This is not about predicting price. This is about understanding pressure. When you look at past commodity cycles, a pattern appears. First, supply tightens quietly, then costs begin rising, then inventories decline further, and finally, markets adjust, not instantly, but suddenly. Picture this happening over the next few months. Mining operations continue, but inputs become harder to secure. Supply chains keep moving, but with increasing delays, markets trade sideways. But underlying pressure builds. Everything looks stable until it isn't. Let's be clear. This is not a guaranteed breakout story. There are real risks. Economic slowdown, central bank, tightening demand weakness. But at the same time, There are real structural signals, multi-year supply deficits, declining inventories, supply chain disruptions. And when these forces exist together, markets tend to become more sensitive, not predictable, but reactive. So now the real question is the market already pricing this in, or is this another situation where the real move comes later? Because right now, you're not looking at the end of the story. You're looking at the early phase of a shift. If this breakdown gave you a new perspective, like the video and subscribe, because we track real signals, not noise. And comment below, where do you see silver going next? Stable, volatile, or something bigger building? Because in markets like this, understanding the shift matters more than reacting to it. And right now, the shift may have already begun.